may have seen some of the many news headlines mentioning that the economy is heading towards another Great Depression. These fears have been sparked as a result of Donald Trump's proposed tariffs, comparing them to the ones implemented by President Hoover in 1930 at the onset of the Great Depression. Indeed, in 1929, the value of exported goods represented about 10% of global GDP. Global trade in the late 1800s and early 1900s exploded from about 4% to 10% of the global economy. In 1930, a new tariff policy named Smoot-Hawley tariffs was put into place by the Hoover administration, which was immediately followed by a significant drop in global trade over the years that followed, seeing the value of exported goods as a percentage of GDP drop all the way back down to 4%, which is where it stood 100 years earlier. It is generally acknowledged that the Smoot-Hawley tariffs and the ensuing drop in global trade were at least partially responsible for the Great Depression of the 1930s. Fast forward to the present day, and we've seen global trade recover from the Great Depression, with exported goods now representing about 25% of the global economy. But today, Donald Trump has set the US government on a path to raise tariffs on imported goods in the United States. Although he recently put a 90-day pause on these tariffs, which we'll discuss the impact of later in this video, it does seem clear that the average tariff rate in the United States will be rising from one of the lowest levels to likely the highest levels of the last 100 years, which would make this shift in trade policy not unlike the ones from the 1930s. And naturally, it brings into question whether another Great Depression is around the corner, which is what followed the Smoot-Hawley tariffs in 1930. So are Donald Trump's tariffs going to lead to another Great Depression just like President Hoover's? In order to answer that question, we first need to understand the benefits that lower tariffs and high global trade offered over the last 50 years. As US companies are doing business in other nations, it provides them with foreign markets. After all, the US population is limited to 340 million people. That's 340 million potential consumers. Being able to access the entire globe provides access to 7 billion potential consumers. And we've certainly seen US companies benefit from this access to foreign markets over the last 40 years. In 1980, about 15% of the S&P 500's revenues came from international markets. In 2025, that number stands to about 40%. So globalization has provided a very real way for US companies to increase their revenues. And this has most certainly contributed to the exceptional returns that US stocks have provided since the 1980s, when globalization really began to pick up. We could also say the same thing about the performance of the stock market in the late 1800s, early 1900s, that was also quite exceptional for that period, and was likely driven by higher valuations and was also driven by higher revenues as a result of globalization. Of course, back then, this significant rise in asset prices also led to higher wealth inequalities, which was accompanied by waves of protectionist and populist policies like, for example, the Smoot-Hawley tariffs, all of that putting an end to this period of prosperity and plunging the economy into a severe depression. The parallels that we have today are certainly something that is spooking investors out of the stock market today. But if we really are heading into a new era of deglobalization, just like in the 1930s, should we not be expecting a much more severe decline to the likes of the Great Crash during the Great Depression? Well, for reasons that I won't get into this video, there are many things that make today very different to the Great Depression, and that make a similar kind of downturn very unlikely to happen, even with a violent trade war. But it's not crazy, on the other hand, to suggest that tariffs could be enough to catalyze an economic downturn in 2025. When we mention the term downturn, we're specifically talking about official recessions categorized by the NBER. The average stock market drawdown during recessions going back to 1970 is 30%, and some recessions have seen stocks drop by 50%, which would take the S&P 500 back down to 3,000 points. So could tariffs actually be enough to catalyze a severe economic downturn, causing potentially much more pain to stocks over the coming months? Well, throughout recent financial history, all economic downturns have come from some kind of shock. In the 1970s, we saw two big oil shocks that triggered these recessions. In 1990, it was also an oil shock that triggered the recession. In 2001, it's mostly acknowledged that the tech bubble bursting catalyzed the downturn. In 2008, the housing bubble bursting brought about the financial crisis, which dragged the economy into a severe recession. In 2020, the shock came in the form of a pandemic. So we have oil shocks, asset bubbles bursting, and a pandemic having all caused recessions throughout history. Could tariffs or a global trade war be the catalyst for the next recession? Well, as we've covered in recent videos, higher tariffs mechanically decrease corporate profit margins, and lower profit margins lead to cost-cutting measures from corporations, which rhymes with layoffs, which rhymes with a recession. We can see this by simply looking at corporate profit margins going back to the 1950s. Almost every single economic downturn going back to the 1950s saw profit margins declining heading into them. Today, corporate profit margins have hit record levels as companies have been benefiting from high revenues and cheap labor from abroad. If tariffs are implemented, it could lead to a radical reduction in corporate profit margins over the next few months, leading to cost-cutting measures and so layoffs and potentially dragging the economy into a recession. So this is the worst-case scenario, but it's far from being a guarantee. Donald Trump has just announced a 90-day pause, and believe it or not, we do think that this changes things. This pause tells us that the Trump administration understands that his initial tariff proposal is quite reckless and could do real damage to the economy. During a 90-day pause, corporate profit margins will likely remain intact, and the Trump administration will be looking to negotiate more favorable trade conditions with other nations. Although the average tariff rate on goods imported into the US will increase, it's also possible that the average tariff rate on goods exported from the US will decrease. There's no guarantee that this will happen, but there's a possibility that trade conditions actually end up being more favorable to US companies on the other side of this panic than what there was before, and so keeping corporate profit margins quite resilient and not necessarily triggering a recession. So there is a strong case for a recession to occur, but there's also a strong case for a recession not to occur. The truth is, although experts on TV are going to tell you that they know for sure what is going to happen next, nobody has a crystal ball.